And very you have animal, polymer, whatever you can speak from you.
Yes, sir.
You can walk around, do something. And we have Wi-Fi. Wi-Fi. Any part of the argument you can hear. Yeah. Right.
You gonna open this up?
Yeah, we will set up before you know. Okay. Good evening, ladies and gentlemen. Kindly settle down. We are about to commence, and may I request each one of you take your place. Yes, we are ready to commence now. The speakers have already arrived. Yeah, once again, very good evening, ladies and gentlemen, and it's indeed my privilege to host another event, which is a very, very high-profile event. Each one of us are looking forward as much as you are watching. All the people who are watching are online. People who are watching on live from various channels of MMA, as usual, if you have any question, send it to the number or scan the QR code and send it to us. All those who are present here, we got a QR code. You can just scan the QR code and send your questions. And all your questions could be related to the subject what we are discussing and not anything which is out of subject. Out of syllabus, both the things are serious. Senior professors from very, very leading reputed college. Out of syllabus, they will never encourage actually. It's within the syllabus, it's fine. Now, before I call the distinguished dignitaries to the stage, let me briefly tell you what's happening in MMA next 2-3 days so that you don't miss them. 26th of November, we have Read and Grow. The Read and Grow series, we are doing it exclusively for the management students because we strongly believe to be a great leader, you have to be a great reader. You read, I've seen many of the experts, senior leaders come to MMA, they're all voracious readers actually. And you can see there's so many books we are discussing because all those readers have written a lot of books and it helps MMA to discuss on some important themes actually. So we have an event on how successful people lead, taking your influence to the next level. We have Sangeeta along with them. Bala Umdi is there, head of human resources from leader of builders and cultural thing. And Arvind Prabha Shankar is also coming and he is going to be a global GCC and GPS leader. This is happening on 26th of this month at same auditorium in person at MMA auditorium. Then on 3rd of December, another high-profile event is being finalized. Arvind Subramaniam, former Chief Economic Advisor, is going to be talking on his recent book, what he's written. We are likely to get Mr. Subbarao, former RBI Governor, and some outstanding people who are going to be there talking to that subject. This is happening on 3rd of December. We are doing jointly with MIDS. And on Monday, the 8th of December, we have event on just been finalized and monetary policy, inflation, financial stability, balancing that, not dilemma, trilemma of thing by, we have Mr. Ravindra Dholakia, he is the RBI governor, one of the known person economist in India. He is going to be coming and talking to us. This is happening on 8th of December. We have one of our good friends, he has facilitated that. We will be finalizing, sharing the invite as soon as possible now. Then on 12th of December, again we have a very, very interesting event. 7th Orcheswamy Memorial Lecture, and this time it will be delivered by Mr. Amitabh Kant, former Niti Aayog chairman and also Jitodi Sherpa. So we have got some lovely people to come and speak next few days. A lot of programs have been finalized. I said few which you should not miss, not to be missed. So mark in your diary and please do come. And coming to today's topic, China+1 Strategy. This you will be reading, talking, wherever you have a corporate or any communication on logistics or any other pharma, you always have this China+1. I know how many of you really understand what is China+1. Today we have outstanding speakers who will be talking to you on the China+1. And plus, you have any query, you can always ask them. They'll be able to address to all your concerns. Ladies and gentlemen, put your hand together to welcome on stage Mr. Srinivas, visiting research professor, East Asian Institute of National University of Singapore, and Mr. Frank Pieke is a Dutch cultural anthropologist and an expert, and visiting research professor, East Asian Institute of National Institute of Singapore, and our own Mr. Casey John, technology entrepreneur, educator, and also dedicated mentor, independent director. May I request the dignitaries please take your place on the dais. Ladies and gentlemen, once again, a very warm round of applause to welcoming our dignitaries onto the stage. The format of the program has already been given in the program sheet, but just for your recollection, I'll tell, I am now going to request Mr. Lakshmi Narayanan, President MMA, to deliver the formal welcome address. Thereafter, I will introduce all the three dignitaries on stage through a special video prepared on this occasion. And then after John setting the context, each of the speakers will speak for 15-20 minutes, 20-25 minutes. Thereafter, the floor will be open to questions actually. Now, I request Mr. Lakshmi Narayanan, President of Madras Management Association, to formally deliver the welcome address. May I have the AV, please?
Mr. Lakshminarayanan Doraiswamy, President of MMA and Managing Director of Sundaram Home Finance Limited, has over 30 years of experience in financial services spanning risk management, operations, and strategy. A former COO of Sundaram AMC, Mr. Lakshminarayanan has also held leadership roles at G Capital and Citibank. He is a commerce graduate, cost accountant, and MBA from Loyola Institute of Business Administration, Chennai.
May I request you to deliver the formal welcome address?
Thank you, Group Captain. Good evening, everyone. It's my privilege to formally welcome you all to this exclusive session on the theme China+1 Strategy. I would like to extend my sincere thanks to the IMA Alumni Association for their support in organizing this program alongside MMA with the valuable support of CAS. This evening, it's my pleasure to welcome our distinguished speakers, Dr. P S Srinivas, Visiting Research Professor, East Asian Institute, National University of Singapore; Dr. Frank N. Pieke, Dutch cultural anthropologist, expert on modern China and visiting research professor at NUS; Dr. K.C. John, technology entrepreneur, educator, mentor, and an independent director. A warm welcome also to all the participants from IMA Alumni Association, MMA, and our partner organizations who've joined us in person here as well as online. For the benefit of our guests and invitees, let me share that MMA was established in the year 1956 and has since grown to become the largest management association in the country, with over 8,000 members and 12 chapters across Tamil Nadu and Pondicherry. We are proud that MMA has been recognized as the best management association in the country for 15 years in a row, including the latest year. Turning to our topic, China+1 policy originated as a strategic response to reduce multinational companies' reliance on China for manufacturing and sourcing. While it gained significant attention during the COVID period, the approach dates back to nearly 2013 as organizations began to appreciate the risks of dependency on a single nation. Key drivers include rising labor costs in China, evolving regulations, geopolitical tensions, and supply chain disruptions from the US-China trade war and the pandemic. Rather than exiting China entirely, the strategy encourages companies to diversify by maintaining operations in China while expanding to other nations such as Vietnam, India, or Malaysia. This approach helps mitigate risks, optimize costs, and enhance resilience through business continuity. India is uniquely positioned to benefit from the China+1 movement. With a youthful population, nearly 65% is under 35 years old and a median age of 28, as well as abundant natural resources, stable democracy, and a growing economy, alongside a technological ecosystem that we are proud of. India is well poised to take on a larger role in the global technology, manufacturing, and services sectors. Tonight, we are fortunate to have experts who offer deep insights into China's policies and global economic shifts. I am confident that their perspectives will be both insightful and engaging. Once again, my heartfelt thanks to our colleagues from the MMA Managing Committee, members of the MMA, the IMA Alumni Association, Mr. K.C. John for facilitating this lecture, our distinguished invitees, partners, and viewers from across the globe. Wishing you an enriching and an enjoyable evening. Thank you.
Thank you, Mr. Narayan, for delivering the formal welcome address. Now, it's indeed my proud privilege to formally introduce all the three distinguished speakers for this evening, and may I have you, please.
Dr. K.C. John is a technology entrepreneur, educator, mentor, and independent director with 30 plus years in innovation, entrepreneurship, and sustainable development. Dr. John has built and exited ventures in mobile computing, VoIP, and health tech, and worked with Qualcomm, the World Bank, and the Ford Foundation. A PhD from IIM Ahmedabad, Dr. John serves on the boards of Kaplan Point Laboratories and Kaplan Stearns, mentoring first-generation entrepreneurs. Dr. P S Srinivas, Srini, is visiting research professor at the East Asian Institute, National University of Singapore, specializing in China's financial sector. Dr. Srini previously worked with the New Development Bank, the World Bank, and the Asian Development Bank, and taught at the Indian School of Business. Dr. Srini holds a PhD from Cornell University, an MBA from IIM Ahmedabad, and B.Tech from IIT Madras. Dr. Frank N. Pieke is a Dutch cultural anthropologist and expert on modern China, currently visiting research professor at the East Asian Institute, National University of Singapore. Formerly director and CEO of Merix in Berlin, Dr. Frank has held academic positions at Oxford and Leiden. Dr. Frank's research explores China's global impact, migration, and the transformation of the Chinese Communist Party.
Ladies and gentlemen, a warm round of welcome to our distinguished panel this evening. As I mentioned to you earlier, after John setting the thing, each of the speakers will share their insight. Thereafter, there will be a lovely free-flowing conversation and Q&A session. Now, I request John, technology entrepreneur, to please set the context and take it forward. You would like to do it from there? You're welcome.
Thank you, Group Captain Vijay Kumar. It's always a pleasure to collaborate with you, Mr. Lakshminarayanan, friends. We meet at a defining moment for global supply chain. What started as a cautious China+1 hedge has now become a core element of global industrial strategy. The world is actively looking for reliable, resilient, high-quality partners. And the big question before us is, can India truly step into that role? Not just as a cost alternative, but as a trusted global partner built on quality, reliability, and innovation. Despite geopolitical tensions, India's trade with China continues to rise, and we have just crossed $100 billion as a trade deficit. That shows that we have to view this both as a vulnerability as well as an opportunity. If India must become a serious +1 player, we need to confront capability gaps, upgrade ecosystems, strengthen supply chains, and rethink our value propositions. Our distinguished panel members, you saw them that they carry with them a long devotion to the Chinese expert, Chinese affairs, and now they are looking at India from a fresh angle. We all look at it from a biased perspective, but they come and look at it, what could be done and how it could be done. So they have been in India for about 2 to 3 weeks. Initially, they spent some time in Delhi National Capital Region, and for last 1 week, they have been in Chennai. And their focus has been to immerse in India. They have talked to a series of policymakers, policy administrators, and corporate captains. And the idea is that they have distilled what's happening and how it is happening. Their research is still evolving, and they look forward to sharing early findings and pose some questions to you so that you can reflect on that. So let's make it an interactive session, provide more feedback, and help in terms of what are the areas which still needs to be probed and investigated. So that's the context in which I thought we look forward for the expert view on what China is currently doing, where China's strengths are, China's weaknesses are, and how China and India could work together despite the entire inherent disputes which we run into. Thank you very much for coming, and we look forward to encouraging and looking at stimulating questions, because the more questions you ask, the experts would be willing to put their thinking hat and respect and respond to that. Thank you very much. I request Dr. P S Srinivas to come and tell us a little bit about the research project, and then we will request Frank Pete to come and do the presentation, and then subsequently Dr. Srinivas would come and do the presentation and provide the conclusions in terms of what they have learned so far, what are the areas where they still need answers, and then it would be open to discussion. Thank you very much.
All right. Good evening, ladies and gentlemen. It's great to be here with all of you this evening, as Professor John mentioned, to share some of the findings of what we have done so far, and more importantly, to get your thoughts and feedback on what we are doing. This is very much work in progress, so we don't have any final conclusions yet. First of all, I'd like to thank the Madras Management Association and its partners for inviting us here. Thank you in particular, Mr. Lakshminarayanan, Professor John, Group Captain Vijay Kumar for inviting us here. I appreciate it very much. Thank you. So, how do I get the slides up here? Can you get the first slide? From China to at least one additional country. The idea is not to abandon China, which remains a critical manufacturing hub, given its established infrastructure, its scale, and its role in the supply chain ecosystem. But the idea is to reduce the over-reliance on it. And this strategy helps companies mitigate risks associated with geopolitical tensions, rising labor costs, supply chain disruptions, and some of the regulatory uncertainties that are increasing in China. This shift began during the first Trump administration, and then COVID-19, as was mentioned earlier, significantly accelerated this process. Some of you in business may have experienced delays due to factory shutdowns in China during COVID, port congestions, high shipping costs, etc., all of which exposed the fragility of single country concentrated supply chains. The policies of the subsequent US administrations only added momentum to this China+1 shift. Some recent surveys basically show that 50% or more of multinational companies currently in China have either already implemented or are implementing China+1 strategies, and about a quarter of the Chinese companies are doing the same thing. And typically, the kind of criteria that companies look to where they want to move to, and this is relevant for India, includes things like production costs, obviously, political stability, the ease of doing business, something that many of you here may be are aware of, incentives, for example, the productivity-linked incentive in India, and the attractiveness of the domestic market in addition to its base as an export hub. Many companies are considering Southeast Asia and Mexico. We wanted to ask the question, what does this shift mean for India? That is why we started this research. We wanted to ask, is India attracting global firms as part of their China+1 strategies? If yes, great. What's actually happening? Why is it happening? And if not, well, why is it not happening? This is what we wanted to understand. What are the views of policymakers? What are the views of the industry on this particular issue? And it's so this, in a sense, motivated our research. Now, as part of the research over the past few months, as was mentioned by Professor John, we met business representatives and policymakers. And one of the things that we realized as we got into this is that it's not just focusing on China+1, but it's also important to understand the overall India-China economic relationship context. And that obviously is a many-faceted, many-dimensional issue. So that's basically what we are trying to get to the bottom of. And as we did these discussions, as we had these discussions, we asked policymakers lots of questions, businesses lots of questions, and they had lots of questions for us too. And they wanted to know wanted us to share a little bit of what we knew about China, what we knew about this. So we thought that's where we'll start this evening's discussion. Frank is going to put together some of the, discuss some of the recent political economy issues, which hopefully would be of interest to you. These were of interest to a lot of the people that we discussed. And then I'll come back and talk a little bit more about the economy and then tell you what it is that we found so far and raise some questions for you that we can hopefully have a discussion over. Frank, over to you.
Right. Thank you very much for being here today. It's a really great pleasure to be here. Also because I'm at least partially Indian. My wife is Indian and I'm an OCI card holder. So India also feels like home to me. Let me just see how this clicking works, because it's always a bit tricky, right? Yep, okay. This is me. This one? Yeah. So, it's very hard to read, but I'm tilt it a bit. So what I will do is take you through some of the more, let's say, important aspects of China's politics and political system, followed by an overview of recent developments in the Chinese economy and economic policy, before Srini again takes over to start talking about trade and investment, foreign trade and investment. So we have had now, or we're currently in the third Xi Jinping administration, and all three of them have been fairly different from each other. So in the first administration, starting 2012 through 2017, Xi was really trying to find a middle ground between very different opposing forces within the Chinese Communist Party and in Chinese society, trying to establish his long-term credibility and power base. And his cabinet, or his leadership in the Politburo, was really a compromise of very different groups within the Communist Party. Now, in the second administration, that radically changed, and he was able to get rid, at the end of his first administration, of his most important, not so much opponents, but people that were critical of him, and more importantly, that were not really beholden to him. So there he could really establish his grip on the party much more, on the Chinese government's system, building and centralizing the party even more than he had done during his first administration, and imposing what he himself called top-down planning on a system that is really very decentralized, and where provinces and below provinces, counties have a mind of their own, have a budget of their own, have ideas of their own and agendas of their own. So that's still a project that is, by the way, going on, but The real crunch came, I think, between 2015, so at the end of his first administration, and 2019, roughly. Now going into his third administration, he had been able during the party congress in 2022 to fully get rid of anybody that would even think about saying things that might possibly be critical to him. The people that were appointed in that administration were all personally loyal to Xi Jinping himself. So this is a crucial fact, and we hadn't expected that at the East Asian Institute. We had expected a more sort of compromise administration. But what in fact happened was that all the other groupings in the Communist Party, we usually call them factions, so groups of people that are beholden to a particular leader, all the opposing factions or the compromises between them had been thrown out the window. Xi Jinping felt himself secure enough to now only appoint to, let's call them, his cronies. The people that he had accumulated over a very long career all across China, from very different parts of China, very different parts of the administration, with very different connections to Xi, but the main point was they were all beholden to him. They all owed their career to a very large extent to Xi Jinping himself. And what then happens, and I have to say a few things about that, is that this new group of people that seem to be uniform and all loyal to Xi immediately start fighting with each other because they are different, they have their own agendas, they're trying to, as it were, find ways of promoting their own careers and the careers of the people that are beholden to him. And very soon this new amalgam of leaders starts breaking up in different new factions. You may have heard of them. The most notorious ones of the more well-known of them are the Fujian faction, both one in the army and another Fujian faction in the party, and they're actually different. Then there is the party from Shanxi, which is the province where Xi Jinping's father is originally from, and where Xi Jinping spent a lot of time. There's the Shanghai faction, there's the Zhejiang faction, and so on. There are about 4 or 5 of them, and we're now at the stage, and it's important to say this, that these factions are fully crystallized out and are openly vying for position. So now it's up to Xi Jinping to keep on balancing this very tenuous constellation. And he does that, and that's also the background of the many purges that you hear about, because he has to purge people that try to now get a leg up on their opponents or their rivals in the leadership from other factions, and they do things that Xi Jinping doesn't like. So he constantly has to sort of punish people that try to be a little bit too autonomous and try to pursue their own agendas a little bit too much. And that's why you have all these purges going on at the moment. We are at the end of what I call an authoritarian leadership cycle, where ultimately Xi Jinping will be the only person with just 5 or 6 really trusted people around him that make all decisions and hold all the power. You saw that very, very nicely at the most recent 4th plenum of the Central Committee. I call this actually a Chinese version of Stalinism. That's really what it boils down to. So this endless cycle of purges, of factionalism, and a leader that becomes more and more alone with just a very few trusted people around him. Now, what does he want to do? The 4th point here on this slide. His focus is very strongly on national strength, national security, and security more general, and competition with the US. So in the beginning, he came to power with an idea. One of the things we have to do is avoid the mistakes of the past made by his predecessor, Hu Jintao. We have to really focus on getting out of the middle income trap. So we have to really ensure that the Chinese economy is built up and is prepared for a long-term leap into a high level that became predominant to his economic agenda. But just as importantly, of course, national strength and national security. Security very quickly started dominating, particularly after the US-China conflict started to escalate. And that conflict has actually accelerated processes that took place in the Communist Party's leadership already. So they were very much focused on national security, very much focused on national strength, and so on and so forth. But the competition with the US put it in sort of in overdrive. because now there was a real challenge and a real problem, and they had to stay ahead of it. And if you want to understand why they're doing what they're doing, this is how it worked. And this happened, this shift happened roughly around 2017, 18, 19, with the first Trump administration. So let me move to the second slide. So that is Chinese politics. I mean, this is just a, let's say, what is a 7-minute overview of Chinese politics. I can give a whole lecture series on it, but I shan't do that, because you get bored. Let's now move into the economy. So we all ask ourselves always the question, what is the secret of China's economic growth? How did it grow? How did they manage to do that? And the answer is, we still don't really know. It's still a little bit of a miracle or a mystery how this exactly happened. But one thing is absolutely certain. Somebody's phone is ringing. Probably in a bag or something like that. Okay, thank you. The first thing to say is that China's real growth happened in the 1990s, 2000s. That was a period in which geopolitics was very much in China's favor. China had a very good relationship with the United States, particularly after the Tiananmen issue had been resolved, let's put it this way, around 1997, 1998. Globalization was the buzzword of the day. There was no geopolitical tensions between the Soviet Union and the US anymore. So China had, as it were, a unique moment to fit itself into the global economy without actually meeting any resistance, meeting any opposition. In fact, it was helped. It was celebrated. It was the world system with the US in the lead was really helping China, allowing China to get into the world system. That was a really important aspect of this. But it's not all. There's also domestic things. The key thing, I think, and it's often forgotten because it is now something that is no longer so relevant, is that local government, for a very large extent, was responsible for economic growth, for also to generate their own incomes, to generate local jobs, and so on and so forth. And they were giving the room to start policies to help companies develop and grow. So this happened at the village level, and I've seen it myself in the 1980s, and particularly in the 1990s, how people with basically nothing at all grew conglomerates of enterprises virtually within, say, 4 or 5 years. But that was only possible because the local government allowed them to do that. They gave them credit, they gave them land, they gave them access to labor, and so on and so forth. So I think the early start of China's growth, miracle, you have to look at the most local level to really understand what's happening. After that had happened, then sort of the leapfrog into the world happened at the late 1990s, early 2000s. But both are just as important. And the mistake that a lot of people make is saying, we let China grow, we let China do all of this. No, China was already ready for it and had prepped itself to take full advantage of the opportunities that were offered with the accession to the WTO. Another very important thing is foreign investment. Foreign investment was not simply seen as free money coming in, but very deliberately local governments used foreign investment to create ecosystems of smaller companies that were supplying that investment, that factory of a foreign company. So very quickly, these companies, these Chinese companies that grew up around it, started copying what the main foreign firm was doing, getting better at it, and then ultimately, after about 5 or 10 years sometimes, they became that foreign investment competitors. And they competed so well that quite often these foreign firms were squeezed out and had to look for other things to do then. So this is China's ability to first accommodate, then copy, and then overtake foreign companies, foreign investments. And that's a very important factor, and this was all encouraged, stimulated, allowed, and facilitated by local governments. China believes in the market economy, but it doesn't believe in it as full-scale capitalism. So when you read through the documents in the 1990s, 2000, even now, you see that the market is central. The market is the most important way of running the economy. but it should never become a capitalist society, a capitalist economy like you have in the United States. They're very, very clear about that. So the market is always a tool, is a facilitator, but can never be a decider. And that is a red thread that runs through all Chinese governments, but is now becoming particularly visible. You also see this in the relationship between state-owned enterprises, SOEs, and private enterprises. You see that private enterprises are good for the bulk of the Chinese economy. It's something somewhere around 80, 60, no, 70%, and state-owned enterprises only 20, 25%. Nevertheless, state-owned enterprises remain leading. They remain the pillar of the economy and the pillar of the governments and the parties' control and grip over the economy. And that will not change. That explains what happened to Jack Ma, for instance, in 2019, when he suddenly disappeared, because he got a little bit too lippy for a private entrepreneur. And he was told in no uncertain terms that that was not the idea. He was not in control, and he was not allowed to actually tell the Chinese Communist Party what to do, which is what he tried to do. Now, that long-term growth model is running out of steam. Has been running out of steam actually from about 2015 at least, if not before. And I can say a lot more about it, but I won't. And increasingly, China has had to move to another growth model, which even more reliant on SOEs, state-owned enterprises, a more explicit industrial policy, where winners are picked and particular sectors are selected for further development, high-tech sectors usually, and very importantly, quite often forgotten, and Srini will be able to say more about it, I'm sure, financialized steerage. So increasingly, Communist parties started believing in the power of the financial market as well, of the financial system, as a tool, as a way of allocating resources all over Chinese society, leveraging also the state-owned assets through the private sector, through the financial system, and that is something that really has taken a great flight. The Chinese Communist Party is now almost exclusively reliant on financialized measures to steer and control and direct the economy. It's no longer a planned economy. There's no longer a fact that the Communist Party says, do this and everybody does it. No, they create the financial conditions for firms to make the decisions that the Communist Party wants. There's even a further spin to it, and that is that the Chinese government increasingly is also an investor state. It is dependent for quite a bit of its income on its own investments, and that is particularly true at the local level, the provincial level, and below that, these governments quite often, for a fairly large chunk of their income, are dependent on the investments, portfolio investments, or ownership of companies and stock. So that shows how capitalism is a tool for communism, as it were. So the two are fused in the Chinese Communist Party's vision of China. Now, what happened after 2020 is that there has been a much greater focus on what is called the real economy, which I think is highly unfortunate. But the real economy is used as a self-evident thing, but it really means we don't want to spend time and money on things that you can't hold in your hand, that aren't really material. And that includes also, let's say, software development and things like that. So what they say is we don't want to follow the US that started to rely more and more on the services sector. That's a waste of space. That's a waste of time. It's good for the people, but it's not good for China, to put it bluntly. And then they point to Japan, they point to Korea, they point to America and Europe as having gone down that wrong path. We have to focus on the real economy. We make things that are real and that add to our economic strength. So that means that China is focusing, as we probably all know, on high-tech development, innovation, and labor-extensive investment and sectors. So what China does really is, and I'll come to that probably later, but is splitting the economy in two bits. So you have the high-tech sector, you have the big private enterprises that are pampered and that are allowed to grow by the state and by the party, and then you have the rest of the economy that is falling behind, where people are maybe unemployed or underemployed, find it very hard to pay their bills, but have really no way out. And that is, I think, the core factor, aspect of China that is quite often forgotten. We look at the glittering prize anywhere and we say, yeah, they've got all these economic problems and other problems, but you know, that's by the by. But these economic problems, they come from something really fundamental, structural, and that is the dualism in the Chinese economy. And that is very much encouraged and fed by what I call superpowering of the Chinese economy, harking back to this point I was making that the US-China competition was leading more and more, was accelerating this innate drive towards making China strong and resilient and self-sufficient. And that means that living standards are suffering at the expense, that China's growth and China's strength is increasing at the expense of the population. So, now this is not what I wanted. Yes. So this is my last slide. I'll go through it very quickly and then I'll hand over to Srini again. So what at the moment are Chinese economic strengths and weaknesses? The main strength, they're pretty obvious and most people know them. An unparalleled industrial capacity, and Srini will say more about it when we talk about trade in particular, where that is glaringly obvious. Nobody can do without China anymore. It has a truly excellent infrastructure that is not just roads and airports and things like that, but most importantly, perhaps, electricity. China has a huge capacity for generating electricity that is more than enough to generate further economic growth. And that is the key sector. China will be the first fully electrified economy in the world. And it has to do with generation of power, it has to do with distribution of power, so high voltage lines all over the place, battery storage for electric storage, EV production, smart roads that are fully electrified, and so forth, and so on and so forth. I think that's the key thing to understand if you want to know where China is going. It will be an economy that is unrecognizable to Indians, to Europeans, to Japanese even, and to Americans, because it will be fully electrified and they'll have ample of electricity to develop further AI tools and things like that. A very, very important thing. And as I said, they have a strong innovation capacity that is getting stronger every day, that is producing new technologies, new products for essentially 2030s, 2040s, 2050s. Another strength that I should mention, everybody knows it, but it's important, China is a long-term view. It doesn't look at what's going to happen tomorrow, but they look at what's going to happen in 20 years from now, 30 years from now, and that continues. In fact, it gets strong. But there are prices to be paid. The main weaknesses. So the over-reliance on manufacturing means that services are neglected, that with that employment suffers, because most employment is generated in the services sector at the end of the day, not in industry. So people lose out, there's nowhere to go, because industry is not hiring, because it's all being run by robots and automation and all that. That means growth is depressed, because the one thing that they always say is we should not spend as a government to generate, to increase living standards and to generate growth, but investment should follow. That generates growth and that generates higher living standards. So it's essentially an investment-driven supply-side philosophy about China's future and China's economy that still remains very much at the heart of what they're doing. Now this leads to involution, a wonderful term that I can say a lot about because one of my students, former student, was involved in developing this term. But it means that there is too much reduplication in the Chinese economy and Chinese political system. Everybody doing the same thing leads to huge wastage, as you see with solar panels and with electric vehicles at the moment. But it also plays out in other sectors. And we all know, of course, that China has a very high debt. Now, it isn't as high as people say. The total debt of China is about 300% of GDP. That's a lot. But it's not public debt. That's also hidden debt. It's debt in companies, in funds, investment for pension funds and things like that. So public debt is actually still manageable. The central government in particular is still doing rather well because they have offloaded all the debt to local governments. So only 24% of GDP is the total debt of the central government. So the ample room to increase that, and that's what they should be doing. But they're very sort of stingy about this. The total debt of Chinese government, local and central together, is about between 88 and 120%. Take your pick, because these figures are really, really soft, and nobody really knows what they mean, but it's somewhere in that range. So, and the budget deficit, as I show here, is between 9 and 11% of GDP. Again, a range, because we don't really know what's going on. We have a specialist in our institute who spent her entire life on China's public debt and public finance. She can't figure it out. Not really, right? So let alone simple anthropologists or finance guys like us. As we all know, there's also an excessive dependence on exports, as we all know, and we'll talk about that a little bit more after this. The dual economy also said. So there is, what China does is there's both a transition into a high quality economy, but also the rest of China is stuck in the middle income trap. And that is something they don't really have a solution for. They don't want to think about it too much. So I think I'll hand over to Srini now, if I'm not mistaken. Yes. These are some slides which I won't talk through because it takes too long, but they illustrate, particularly this one. It shows that services, that rural employment is remaining the same or is getting worse, but particularly this slide is very, very telling, because it shows you that after COVID, services didn't grow like a normal economy would do. No, but the service sector was depressed, because many people working in services sectors couldn't get a job anymore because there was no consumption, there was no expenditure, and also people were sent back to the countryside quite often who were doing things in the service sector, and instead industry stayed at the same level. So this is, to me, this is the most telling slide of all about the structure, contemporary structure of China's economy. Peak China, yes. No, we don't know. The Chinese say no, the Americans say yes. I say one bit has peaked, but the other part keeps on growing. So, yeah, I can't talk to this. I said most of the things on these slides already, so I'll now hand over to Srini again.
Thank you, Frank. I thought I'll pick up, you've seen some of the developments, the recent developments in the economy. Frank has told you a little bit about the politics. I thought I'll just cover a couple of issues before I get into what it is that we have done and what we have found in our discussions. And the first one is a little bit getting into a detail of what Frank touched upon, which is debt. He mentioned the debt-fueled economy. This is on the left-hand side of this, shows you how debt-fueled it is. The blue line right on top, that's China's total debt, roughly 300% of GDP. I put in the US there as a comparison. That's the red line in the middle, and the bottom green is India. Just to show you the difference in the leverage of the economies. And in terms of the bars, just to show you, pick any one, let's say pick the leftmost bar. The light blue line is China's central government debt. The next one, the yellow one, which is the important thing to focus on, and which is the one that grows the most over the last 10 years, that is the local government debt, or that is the corporate debt. It basically includes all local governments, private sector, corporate, state-owned enterprises, everything else. So that's there. And the little brown one on the top, that's household debt. So, and for all the three economies, that's the comparison. For India, the dark red line right at the bottom, that's the central government debt. The next color, let's call it dark brown, I guess, that's the state governments and corporates, and then the little black line, that's the household debt. So it shows you that it's a very leveraged economy, and with leverage come risks. So it's important to keep that in mind. And given that this is, many of you are in the business side, I can't talk about debt without talking about equity. So I put the equity on the right side. That shows you the market cap as a share of GDP. I know market cap is not a good measure of all the equity in the economy. It's subject to market fluctuations, all of that caveats. But still, that shows you where the green line on the right side, green bar, that's India. So it's India has much more equity in its economy than China has, which is the blue line. So this clearly shows you, to what extent there are, sort of the differences in the way the two countries have chosen to finance growth, and this is important in terms of understanding the overall context between the India-China economic relations. Now I'll just talk a little bit about trade and the trade. This is the trade imbalances or the global how countries are faring in global trade over the last 3 years, ending in 24 December. The light blue lines at the bottom is the US trade deficit, and the red lines on top are the China's trade surplus. Okay, so and for India, it's the yellow or the orange line, whatever you want to call that color. So basically what's been happening, the US's trade deficit keeps increasing and China's trade surplus keeps going up. Okay, and so this is basically, and India has largely been, with a little bit of fluctuation here and there. So India is not a major contributor to global imbalances. But while it is not a contributor to global imbalances, whatever is done by the other two major contributors, which is basically China and the US, affects India. So India needs to be ready to deal with those global, with the impact of those global imbalances. So with this being the trade, with this being the sort of the trade situation globally over the last 3 years, what's happened post the tariffs? Here you can just focus on the last two bars, which is the quarter one, first and second quarter of this year. And the most telling one is the last bar on the right side, which is basically post the tariffs. So in the quarter from March to June of this year, US trade deficit shrank considerably. It went from about $425 billion in the first quarter to about $265 in the second. So it's quite a considerable reduction in the US trade deficit, which is what all the tariffs were meant to accomplish anyway. So, and then India is the light blue line just below the x-axis. So that, that sort of has remained, approximately the trend, what it has been over the past several quarters, several years. But the interesting story is in neither of these. The most interesting story is in the dark blue line above the x-axis, which is China's trade surplus. And interestingly, that hasn't changed much at all. So despite the fact that the US has significantly reduced its imports from China and from the rest of the world, Chinese exports haven't changed. Okay, so the question is, where have all these gone? And that I'll talk about in just a minute. So basically, this influences the dynamic of how China deals with the rest of the world. Okay, so while, just to make the point again, US has significantly reduced its trade deficit. China's trade surplus hasn't changed significantly. It went down very marginally. So, in that context, again, to understand the focus for the India-China relationship, what exactly is happening, this chart essentially shows you that China is no longer dependent on the Western world as much as it was. The green line, starting from the top left-hand corner going down, is the share of China's exports going to the G7 plus EU. So let's call that the developed world. So in 2000. So it started at about 70% of China's exports would go to the developed world in 2000. In 2025, it's 40%. So it has consistently reduced its dependence on the Western world. If you look at the light blue line, that is the dark blue line, which is the second line on the left, that is its exports to the US. 25 years ago, 30% of China's exports used to go to the US. Today, it's half, 16%. Okay, so the China depends a lot less on the US than it did 25 years ago. Where are all these exports going now? They are going to developing countries. Okay, so the point is the developing world is far more important to China today than the developed world is. And since we sit in the developing world, correspondingly, we need to get this dynamic in order to understand what's going on. The light blue line that you see, which is the third line on the left, that India is not a part of that, just to start, but it is China's exports to pretty much the developing world, broadly put. It's exports to what are called the Belt and Road Initiative countries. It's about 120 developing countries around the world. to which China exports. So that has doubled in the last 25 years. So the point just to be made is China is no longer dependent on the West, and therefore has a lot more leverage with the West, and therefore is able to take a lot more pressure from the West because it doesn't depend on them as much as it used to. Now, who are China's key export partners? Very briefly here, again, you can see ASEAN, the light green one at the bottom. I thought the colors looked much nicer on my, okay, they look okay there. The light green at the bottom, that's ASEAN, and that is the place where most of the exports have gone to. So China's immediate neighbors, basically, in Southeast Asia. And the India is the okay. I need to get this is the brown bar right below the light blue bar. So it's the third from the bottom. So that's India there. And the message from this and the left part of the chart is in absolute dollars, in dollar terms, and the right side is as a share of China's total exports. Okay, so you can see that, both in absolute dollar terms as well as in as a share of China's exports, the brown line, which is India, is small. So while for India, China is its single largest trade partner, for China, India is very small. Okay, so this clearly defines a very asymmetric relationship between the two countries when it comes to trade dynamics, when it comes to investment dynamics at a macro level. And one needs to, that is the reality. This is the slide this covers from 2009 to today. So we are covering about a 15-year period. And over this period, India has had multiple, growth regimes. So over all this period, as China has grown to India's largest trade partner, India has remained a relatively small share of China's exports. We have seen, looked at debt, we have looked at a bit of trade. Let's look at investments. What is China doing with its foreign investments? China now is one of the largest foreign investors in the world. It's not the largest, that's still the US, but, this is one of the largest. This shows you what's happened over the last 10 or 12 years. And the story is almost entirely in the top three bars, the light green, the yellow, and the dark green. Basically, the same story as in trade. China invests a lot more in developing countries now than it invests in the developed world. It invested a lot in the developed world 10 or 12 years ago. It doesn't do that anymore. Most of its investments go to ASEAN, it goes to the emerging countries of Europe, it goes to the Middle East and North Africa. And this is, there is also, so basically, once again, China is not as dependent for its investments as it used to be on the West, and about half or more of its investments are in manufacturing. The big sectors are on the right. It's basically energy, strategic industries, electronics, semiconductors, which people here would appreciate, mining and materials, etc. So these are the areas in which China invests. And this chart is basically, the most interesting part of this chart is what it does not show, not what it shows. The left side is India's overseas investment, and the right side is China's overseas investment. In the red on the left is China. You will have to search really hard to find the red on the left side chart. And similarly, on the right, the yellow is India, and you will have to search really hard to find where India is on the right side, which basically means that neither country invests in the other in any significant way. India does not invest in China, China does not invest in India. And so this is, as I said, what this chart does not show is actually the more interesting part. So we have, if we are going to think about getting more engaged in China+1, this is the base that we are starting from. Okay, we are starting from a pretty low base. All right. So now I'll get to what have we found in our discussion so far. As I mentioned, this is research in progress. We'd love to have more conversations with you here outside. But these are some of the conversations that we had and our findings. There are two broad areas in which both business sector and policy makers fall into. One area is areas where they agree. So these are the areas where there is kind of consensus. I call them the consensus areas. First, there is no question that, given it's the largest country in the world in terms of population, it's the fastest growing large economy in the world. We have one of the youngest demographics in the world. India's demographic and market potential, there is no way that any large player who wants to be present, who wants to, participate, cannot be present in India for the long term. That is a universal agreement across everybody that we have spoken to. So with that, and there is also sort of a positive, a very positive sentiment in terms of an excitement about India's potential. And there is also an agreement that India actually is benefiting from China+1 strategies. Yeah. Yes. These are Indian views of India's importance. Okay. And these are across businesses and across policymakers. And I'll come to the differences in just a minute. And there are considerable differences, as you might expect. Have I answered the question? Okay. All right. So there's basically also a lot of positive and excitement about the potential of India. That said, there is also an agreement that there are serious structural disadvantages with respect to China. And Frank touched upon some of those. There is almost universal agreement that India cannot compete with China today on manufacturing scale, on cost, on supply chain integration, and speed. And these are some of your colleagues in the business community telling us that, okay? So this is not my conclusions. China has too many cost advantages. China has an ecosystem that is very mature. So there are significant hurdles that India needs to cross. There is also the unresolved India-China border issue, despite the handshakes in October. And clearly, economics is always comes second to politics. So therefore, there is a necessity to resolve that, or to at least reach a political agreement on that is acceptable to our political leaders. And any substantial growth in economic relationship will be subject to the resolution or agreement on geopolitics. And the last issue, again, on which there is agreement is that ease of doing business in India is not uniform, and it varies considerably. We are in one of the states that is heralded as one of India's best states to do business in consistently for a long time. That's not the same case with other states, and so that creates a challenge for businesses. So these are some of the areas where across the board people agree. Now, of course, there are areas where people don't agree, and here is some of the contentious areas that we have found out. One, businesses want to separate business from politics. So they would like to continue to do business with China either as trade partners or as getting investment, and they want to try to figure out how to separate that. And there is an example in the world which has successfully managed this, and that is Japan. Japan has very serious political differences with China, but somehow they have figured out a way in which their businessmen and their business community does an enormous amount of business with China while having very serious political differences. So maybe something to be discussed and seen whether something of that applies. Yes, they don't have a land border, that is true, but they are close enough in other areas. So they have some serious issues, something to think about. Businesses also want to actively engage with Chinese firms, and what is considered, what I say is do a China on China, What did China do 20, 30 years ago when it was attracting global capital into China? They basically insisted that along with capital, if somebody wanted to open a business in China, they had to bring technology, they had to transfer the technology, they had to upskill Chinese workers, they had to form joint ventures. So they had a series of conditions in order to allow the global capital to come in. Now, it may not be the same world as it was 20 or 30 years ago, but something that India needs to think about in terms of would there be what kind of an environment does India need to create in order to get businesses from there to here, to do a China on China basically. And then the other view is, from the business perspective, is India's restrictive policies are a hurdle, the same the doing business issues. Now comes the strategic issue. So some of the policymakers, in fact some of the businesses too, which is the opposing view, which says, look, China is to call it most politely, a non-benign actor as far as India is concerned. So deep economic integration with a non-benign actor is simply not possible, and it poses a national security threat. So these are the views of the people that we spoke to. I want to qualify it once again. And therefore, India needs to take a cautious approach. They need to prioritize strategic autonomy. We need to prioritize self-reliance, Atmanirbhar Bharat, even if it means slower growth. So we have had conversations in which people have been explicit that, if necessary, we take on slower growth, but that's a price worth paying. And the priority should be to try to diversify supply chains away from China rather than deepening the dependency. So you can see two completely diametric views amongst the people that we have spoken to. And another area where there is contention, and there have been many areas, but given the shortage of time, I'm just going to focus on this one. There are both critics and proponents of China's policy stance since 2020. And what do the critics say? They basically say that policies like the Press Note 3 and the quality control orders, which many of you in business definitely are more than aware of, that they are disproportionate overreaction. They damaged Indian businesses. They cut off access to capital, risk capital, and ultimately they didn't work anyway because the trade deficit, look what happened to it, okay, even with all of these things, okay. So that is the criticism. And then the idea is also the quality control orders, etc. What they actually accomplished was increase the input costs of manufacturers and make Indian exports uncompetitive. And they basically created this tension between protecting domestic industry and allowing India to become a global hub. So these are what amongst the group of people we spoke to, the critics say. And what do the proponents of this policy say? They say, look, these actions were necessary. It was important to signal to China that what it did was unacceptable. They protect national security in the face of Chinese aggression, and they represent a fair balance between economic and security interests. So that's what the proponents say. And then the protectionism is also necessary to shield nascent Indian industry from Chinese competition so that we allow them to scale up. So these are two different kinds of views that we get. So I've told you what is it that we have heard. So maybe it's time to sort of our view based on what we've discussed so far. In our view, greater economic engagement with China will be necessary for India's own self-interest, but it needs to be on India's terms. India needs to define what the terms of its engagement is going to be. And we have set ourselves a target of Viksit Bharat by 2047. It is going to be difficult to get that 8.5% of GDP growth that we need between now and 2047 without further engagement with China. It has the necessary technology, it has the capital, it has the skills, and all of these available at an economic cost, economic price. So they are available economically. So we have to figure out a way in which we can engage. So in that sense, China+1 and figuring out how best to do it is going to be important. Border and security issues are clearly very important. And our political leaders, that they need to find acceptable solutions. Both trade and investment pose dilemmas for India. between 2020 and 24, as I mentioned, our trade deficit with China doubled. And this was in a period when the relationship was not very good. Let's suppose the relationship actually improves. And let's suppose India's growth rate improves even more. What do you expect the trade deficit to do? And if 100 billion itself is a problem, what will be a much larger trade deficit? So that is one issue. But then, attracting greater investment from China also means how to deal with the domestic manufacturers. And they have challenges in terms of taking on the Chinese competition. So these are some issues. And the last is, from our perspective, is, as Frank mentioned earlier, the West allowed China to grow, to develop, to become what it is today. It is, and China has learned that, it knows it very well. It is highly unlikely that China is going to allow the same thing to happen to India. Okay, so it is not going to be as generous in its contributions as the West was to China. So the question is, there are going to be always some parts of a supply chain that India is not going to get, at least not from China. So then, so therefore the dependency will continue. So the question is, what balance do you find in all of this to make sure that, yes, we do get something that we are happy with on our terms, but at the same time, we appreciate that is what, the reality is. I'll just leave you with these questions. I have a bunch of them that I put up on the screen, and maybe with the help of of Professor John, the moderator, we can take on some of these questions. Thank you.
Thank you, Dr. Srinivas and Dr. Frank. I must say that it was a very penetrative analysis and rich insights drawn from looking at both China's growth experience as well as how China is overgrown the reliance on Western economy and looking at more developing countries to their trade balance problem. So I'm sure there would be a series of questions coming up. While the questions come, let me raise two questions. One to Frank: is the dual circulation model working? Because what you are acknowledging is that there is a depressed demand, consumption is not growing, and of course, even though there is a reversal in globalization, China has overcome that reversal of globalization by banking on the developing world. So what's your sense that the dual circulation model is working? What are the challenges there, and how China is overcoming that? So that's the question for you.
All right. Dual circulation means two different things, as you already alluded to. The first one is to create or relocate supply chains as much as possible to China, or develop them within China. So the key word is self-reliance. The key word is not consumption economic growth. So in that sense, China has made huge strides in the last 7-8 years, since 2020, in particular when the word dual circulation was first mooted, in doing just that. And they did that in part through financialized measures, but also, to my surprise, using old-fashioned planned economy style guidance and even planning. So governors of provinces, for instance, were made responsible for creating supply chains for specific key industries in their province across China. So that is what I am very familiar with from China in the 1970s and even the 1980s. So that's one thing. So they're successful there, but they're successful only on their own terms, not in terms that we would normally understand, like economic growth and things like that, distribution and what have you. Distribution is just left to other policies, right? Dual circulation is also that you rely on the world. They used to say for the things that China really needs, but what it has boiled down to is investment in strategic sectors, strategic technologies. That's the real focus at the moment. So to try to tap the world as much as possible, the things that China still needs from it, that contribute to its own strategic priorities and not inviting foreign investment across the board. But secondly, and much more importantly, and that is what Srini has been saying in his presentation, export. So this, you can call it dumping, you can call it export glut, whatever you want to call it, but that to them is also due to circulation, but it's circulation away from China, right? So I think on the whole they have been very successful. And the question is really, are they being allowed to continue that? That is the real political question. And that is something that I have views on, but my views don't really matter because ultimately I'm not the guy who makes any decisions on this.
I have a question for Dr. Srinivas. You told us that Press Note 3 has been detrimental for India. Yeah, is this audible? Press Note 3 and its impact, right? Trade deficits are increasing. India exports around about 14 billion to China and imports around about 115 billion, right? Now, what are the lessons which India could learn? Because you had conversation with the policymakers and you have also had some conversation with those who import from China. Now, what lessons are emerging from your conversations which would help India to reverse the trade deficit, because it's something which is pretty tough?
But I mean, I think, first of all, when I mentioned about Press Note 3, I made it very clear it was the views of the people that we spoke to. I just want to clarify that for the record. And I'm happy, in terms of trying to reduce the trade deficit, from an economist's perspective, in my view, politicians are hung up on bilateral trade deficits. It's important to keep in mind that, yes, bilateral trade deficits, you need to keep your eye on it. I'm not saying that's not the case. But as long as you are a growing economy and effectively using what is it that you're importing, a bilateral trade deficit is not, from an economic perspective, a major problem. Okay, it's more a political problem than an economic problem. And so if India needs the intermediate goods, the APIs, the machinery, etc., to grow at 6.5%, 7%, 8%, whatever its targets are, and the most efficient way to get it from is China, so be it. And and so, as an economist, I'm much less concerned about a bilateral trade deficit as long as the overall trade situation looks good for India. But on the other hand, I understand that this is a political problem. So I think I'm going to leave it at that.
Great, thank you. So there is another question coming up for you, Dr. Srinivas. What's the role of innovation and technology in China's growth, and what India could learn if India has to catch up? Because there is a huge difference between the China and India story. So what China has done positively about innovation and technology, and what lessons are emerging for India from that?
Yeah, I think there was also another question that I saw on R&D, so maybe both of these can be combined. I saw that on the screen. China clearly invests a lot in R&D. If I'm correct, it's investing now as a share of GDP, either comparable to or even more than the US. It is actually the highest number of published papers, research papers, and one step beyond that, it's the highest number of citations of those research papers. So actually things are, and then in terms of patents, all of these China is leading now. So it has had a systematic approach to its innovation environment. It has invested, it has attracted people that it felt would help its research efforts from overseas, from within the country. It has set up institutions where these people can work, and then it has also tried to be, in some cases, China has been at the cutting edge of technology. On the other hand, it has been at the cutting edge of operationalizing existing technology. Sometimes, being first is not necessarily the greatest thing. You're being second, but doing much better than the first in operationalizing it is actually not such a bad thing. So I think, there's an entire China takes pretty much an ecosystem approach to just about everything. In fact, in one of our meetings, we learned that there was a person who is now looking at trying to publish journals in China. Now, that is sort of so far ahead in terms of thinking about research and innovation, because ultimately you got to publish this stuff somewhere, but China thinks about everything from the start of the research to the publication of the journals. I think that's the kind of approach that is required. We don't have to put everything into place at the same time, but we definitely need, in terms of lessons, significantly more investment, probably significantly less bureaucracy, and and sort of more trust in some form amongst the researchers in terms of what is it that they are expected to accomplish. I mean, they have to be held to standards. That's not the question, but innovation and research is very different from sort of a 9-to-5 job. So therefore, there one needs to understand the difference and invest in it for the long term.
Frank, there is a question: how much has India gained from China+1?
Yeah, I saw that question. Basically, it's...
Too early?
No. Of course it's too early. It's always too early. No, but it continues on from what Professor Srinivas has been saying. I think on the whole, India's benefit from China+1 has been very modest. It's very hard to exactly put your finger on how much or how little that was, because one of the things that happens is, for instance, that foreign firms that are already in China simply start investing more. Now, you don't really know whether they do that because of India or because they do that because they don't want to be so beholden to China anymore. So that's impossible to tease out. You can only do that qualitatively by talking to the managers and the CEOs, saying, what kind of strategic decisions do you make? And I don't think that India can compete really, given what it is, with Southeast Asia, with Mexico, as pure China+1 hubs, where people set up factories, or assembly plants, or just sew some buttons or whatever, for then further export to the United States or to Europe or to Japan, or back to China for that matter. I don't think that should be India's game. India is not good enough for that. India is fundamentally, and I don't like to say this, but it's true, is still an inward-looking economy. So what is India's strength? It's its market. It is its population, the fact that if you set up shop here, you have a huge market to cater for. So what you should say is China+1, yes, but you should serve the local market here and don't look at India as an alternative to, say, Malaysia. That's not going to be a winner. So that's as far as we go at the moment. Following on from Srini, I think that, wait, let me think. Sorry, I forget the point that I wasn't going to make, but I'll make it in a minute when I remember. Sorry about that.
Right, Dr. Srinivas, in terms of capability gaps, I'm trying to go beyond that question there. The challenge for India is capability gap, both in terms of policy perception as well as in terms of strategy evolution at the corporate level. So what's your sense? Both of you have looked at China much more in depth, and now you have spent about 2 to 3 weeks in India. What are your emerging perception about the credibility gaps and the gap in terms of capability between India and China, and is there a way forward in terms of bridging those gaps?
I mean, I think, in my view, yes, there is definitely, a way forward. You want me to answer this question first, or you want me? Okay. So let me try to do that. So the question here is, what are from a financial perspective, can we go back to the previous one so that I can see the question, if you don't mind? Okay. Yeah, so I think the person asked, Swati asked what the financial risks are. Three views, three things in my view. One, I mean, looking at it purely as a financial sector, as a financial person, but a lot of dependence on China has P&L risk, which is basically if by chance they decide one day that they're not going to supply you what it is that they plan to supply you, you immediately have a problem. If so, excessive dependence on China, that is one issue. If you are dependent on China significantly for investments, then you have balance sheet risk. Obviously, the point is, as investors, it is a bit harder for them to take it away, but at the same time, you potentially have constraints on that. And then, a large dependence on China also, which is one of the reasons why companies try to move to other places, which is, if China, for whatever reason, some of the risks, for example, they had, China has a lot of rules now regarding security issues, or, if it has a supply chain problem, for example, as during COVID, it has issues with, executives, in China, some of them who have faced risks. So all of these, it can create fundamental existential issues for the firm. So all of these are areas in which risks that companies face in terms of over-relying on China, and which is exactly why the China+1 strategies have been looked at by companies. And what can India do in terms of offering these? Exactly, in a sense, an environment where these issues are much less of a concern, and where again, as I mentioned upfront, I am a firm believer that it should be done on India's terms. And so once but I think the critical issue in dealing with China is clarity on what is it that we want. And the one thing about China is they're crystal clear about what they need, what they want 10 years from now, 20 years from now. That's what they want to get. And I think as long as we are clear and we define the terms of the engagement, I think we should have a very good experience in terms of engaging on this particular issue. But that clarity is tough to come, but it's important to have it.
That could be the difference between a centralized decision-making vis-a-vis the distributed decision-making, right? And so you're alluding to that. I guess that this question is being addressed considering trade deficit of 100 billion. What are the main areas India should look at, and you address that, right? So we'll go to the next one, and that will be the last question. Can you go to the next question? What share of China's FDI is debt and what is equity? If it is largely debt and these are to be developing countries, what has been China's response when there is inability to pay?
Okay, this is a topic which is going to take more than 2 minutes. Whoever is the person writing this, I'm happy to leave a number. This is something I've worked a lot on, so I'm happy to give you a very detailed answer. The short answer to this question is a significant amount of Chinese investment overseas, and that is what I presume you're asking, is debt. And now, and that's not just true of China. I mean, across the board for many countries, that's the case. But for China, yes, it is large. Equity is a relatively small share, but that the sustainability of the debt and the ability of the countries to repay, etc. It's all case by case, country specific. I can't generalize, and China is learning its own lessons as it has evolved as an investor. The investment started sort of in that say 2010-ish roughly, and it has since then become a very large investor in the world, if you want to call it either as debt or equity. So I'm only partly answering the question. Happy to share with the person, and we can have a bilateral conversation. It's too technical to answer from here.
Thank you so much. I guess that group captain is saying that you have stretched your time, and he's asking me that next time he will not give me the moderator's role. So come over, group captain.
Thank you, Mr. John and Mr. Srinivas and Frank. It's a fascinating evening, a lot of knowledge. I know people must have really got a lot of insights and gone more wiser in China+1, and we have over 520 participants watching online. There's so many questions that come. We couldn't most of the things we answered, but we tried and picked up some other questions. May I look like Lakshmi to please join us on stage to present a memento on behalf of MMA and join us. Come.
Oh, thank you.